Are you investing in 2025? If so, how do you plan for it? Because this year, the game's changing. There are five key factors that will shape your returns and your investment decisions. And if you don't factor them in, you'll not only be left behind, you're missing out big time. So in this video, I'm going to run you through these five key factors that'll impact how you invest in 2025 and how to stay ahead of them. So let's dive into this video. Hi, for those of you who don't know me, my name is Jadu Srikandan. I'm a buyer's agent for property investors and I buy properties all around the country using a data-driven approach. So if you want to work with me, go to my website propertyframeworkbuyersagency.com.au and book a session with me there. Now let's get into these five factors one by one. Now the very first one and the obvious one is the interest rates. By now you should be already knowing that interest rate cuts are imminent because of the trade wars that are happening right now. With Trump's tariffs, even though the Australian economy isn't directly affected, we know that the Chinese economy might get affected through those tariffs that the US has implemented. And if the Chinese economy is affected, that indirectly affects the Australian economy. And because of that, interest rate cuts would most likely happen. And it's predicted that at least 3 will happen by the end of the year to stimulate back the Australian economy. You've probably been seeing all this in the news. And another thing that's been floating around is that because of these tariffs, there could be some volatility in the share markets and people could feel that share markets are more risky and put their money into something more safer, that's property. So the chances are, like with these changes and the fact that Australian houses are already in shortage, it's very unlikely that property prices are going to decline or be negatively impacted by these changes. The more likely chances are that property prices are going to be rising up. But they're only going to be rising better in selected areas. And that takes me to point number 2. Where do you think this change will impact the most? That's the critical thing that everybody wants to know. And I think where it's going to impact the most, when the interest rates were going up, the markets that stagnated or declined in value, those markets would see buyer sentiment improving and also property prices starting to recover. So basically, I'm talking about markets in regional NSW, regional Victoria, regional Tasmania, because I'm only talking about markets under 600,000. I'm restricting it to markets under 600,000, and that's why I'm only talking about these regional areas. These are the markets that are going to see recovery and prices moving upwards. This table here, this shows the growth in these markets. So I've taken 6 markets in regional Victoria, 1 market in NSW, which is Albury, and then 3 markets in Tasmania. And you can see the growth over the last 3 years in all these markets has been pretty poor. Some of these markets have declined by about 10% even, especially markets like Geelong and Ballarat have performed poorly over the last 3 years. And even if you see this inventory level, it is still quite high. These markets don't show tight inventory levels, but the thing is that on the ground, things are starting to change. Things are changing. The dynamics are changing. I can already see that there is more pressure building up in these markets. Okay, it hasn't really gone to a hotspot kind of situation, but pressure is building up. In some of these markets, listings are starting to drop. I've done another video on Ballarat where you can see listings are dropping in the Ballarat market. So go and check that out if you already haven't. I've also done a video on Melton showing how listings are starting to drop in the Melton market. So go and check out that video too if you haven't. And then the rest of these markets, yes, the pressure is starting to build up. And this is where you can have good buys. In some of these markets like the Latrobe region, you're still able to negotiate and buy well. Okay, you don't have to go to Queensland or WA, compete with all these other buyers and get something. That's only if you're desperate for short-term growth within an year or so, right? But if you're prepared to wait it out for a couple of years, you could see some good returns in these markets. That's why I'm sharing these markets with you. And so the only con that you have to factor in these markets is that the rental yields aren't excellent. You're talking about rental yields around between 4 to 5%. It is not the typical Queensland WA yields where you can get up to 5 to 6%. So your cash flow could be affected. And the other thing that you also have to factor in Victoria is that Victoria has minimum rental standards. Now, these standards aren't that unfair. They're pretty reasonable, but you must make sure that you're addressing them prior to purchasing the property. So always make sure you have a property manager inspecting that property and giving you the feedback on that property. That's a must, especially when you're buying in Victoria. That's the second point. Now I want to go into point number 3. And that point is that you no longer can buy properties in the 200s and 300s in 2025. Those properties, 200,000s and 300,000s, those properties do not exist anymore. What we are seeing now is that entry price points are at least around 450,000 for good quality homes, even in the regional markets. And all these properties are going to be negatively geared by 8 to 10,000 because of the interest rate environment we are in at the moment. So 6.50 interest rates, yet these properties are going to be negatively geared by that amount. And in Victorian markets, the negative cash flow could be higher, could be around $12,000 to $13,000 per annum. Okay, but here's the thing. Interest rates would drop. Let's say the rate drops from about 6.50 to about 5% within the next couple of years. That could significantly affect your cash flow in a positive way. Even in the Victorian markets, you'll see a significant improvement. And that's why I wanted to show you this example. Let's say you buy a $480,000 property in Victoria right now, which rents out for $420 per week. It's at 6.50 interest rate, a 10% deposit. Year 1 with a 6.50 rate, total rental income minus total expenses, you're at minus 13,546. So that's fairly big. It's a big amount. And I can see why investors are hesitant to get into Victoria because of these lower rental yields. They're scared that because of these lower rental yields that their cash flow would be affected and therefore they move to other markets. When you look at this deeper, let's say the rate drops to 6% in year 2. That already improves the cash flow. It drops to minus 10,756. Let's say by year 3, it drops to 5%. Cash flow shows a significant improvement. Look at that, minus 5,764 is the negative cash flow, a significant improvement from the minus 13,546. So what you have to factor in is that even though, yes, the cash flow is looking bad now, with the interest rate cuts that could happen, your cash flow could improve even in markets like regional Victoria. So don't miss out on opportunities thinking that the cash flow is bad, because it is going to improve down the line. And also remember, moving into the future, there is also a possibility that negative gearing could be scrapped, not immediately, but in phases. And if negative gearing gets scrapped, that means you would have to manage the cash flow, right? So don't look at after-tax expenses. Don't factor that in. Make sure that you're comfortable with these cash flows even without those tax returns. And if you're comfortable, that means you're safe to invest. Okay, so always keep that in the back of your mind. It's something that could happen. Let's move to point number 4. We are living in the age of AI. As of today, there are a lot of tools that can give you markets, okay, that can give you the hotspot markets in the country. But it is still important that you understand the data, understand what is driving the growth, understand the factors that are driving the growth. For example, the regional migration trends. For example, the population movements, the infrastructure projects, and also being able to understand supply-demand data on a deeper level. So in that way, you're not just relying on some data that's coming out of a platform showing you some hotspot markets. You can go and interpret this data in your own way. And in that way, you can spot markets before they're about to turn, okay? And that becomes really important. But having said that, in the age of AI, I think moving forward, AI would automatically be able to do this using the data. It can predict the markets that are about to turn, cool markets that are about to turn. AI should be able to do this in the future. But until that, which is about a few years away, you should still be able to read the data deeply and understand market trends. So that becomes more crucial in 2025. And the last point, I think in 2025, with the interest rate cuts just about to happen, it's a good time for people to refinance and then reassess their portfolio to get ready for future purchases. So what I mean by that is that if you have assets in your portfolio that are underperforming, it could be a time to free up capital so that you're ready to buy in the correct markets just before the interest rates drop. For example, what I mean is that if you have an apartment in Sydney, for example, that has been performing poorly, apartments in Melbourne CBD, which have been doing nothing for several years, okay, or you have a very highly negative cash flow property, it could be a sign to sell these properties right now so that you can get ready and free up capital to invest into the right markets when the interest rate cuts come, when the borrowing capacity improves. So it could be an opportunity for you to reassess your portfolio, restructure your portfolio. But be careful of not selling the wrong assets. For example, markets in Melbourne, markets in Geelong, if you would think that they have been underperforming and if you sell them now, okay, for example, let's say you bought a property in 2022 in Geelong and that property hasn't been doing anything for the last 3 years, please don't make the mistake of selling that property because these markets are now turning. So any market, for example, in regional Victoria, regional NSW or regional Tasmania, if you had bought them in 2022, they wouldn't have done anything. So don't make the mistake of selling the wrong asset. Make sure that you know exactly what you are selling and make sure that it fits in with your future plan. So these are the 5 factors that will shape your investment outcome in 2025. So make sure that you understand these 5 factors well. Thanks for watching the video. So please like and subscribe to my channel and I'll see you in my next video.